The silver market continues to command global attention as prices move sharply in response to recent structural shifts. Today's movements are driven primarily by margin adjustments on Comex, institutional repositioning, and broader macroeconomic factors. Understanding these elements is crucial to interpreting short-term volatility without jumping to conclusions. Before we begin, if you want clear, fact-based insights into silver, banking strategies, and market trends, subscribe to the Monetary Silver Brief. Each report focuses on verified data, structural analysis, and market signals, not hype or speculation. Margin hikes on futures contracts directly impact leveraged traders. When margin requirements rise, participants must allocate more capital to maintain the same exposure. This often forces position reductions or outright liquidations, creating short-term selling pressure. It is important to note that these reactions are structural rather than sentiment-driven. The intrinsic value of silver remains unaffected by temporary mechanical adjustments. Institutions, particularly major banks, respond methodically to such changes. Reports indicate reduced short-term trading activity in paper silver, but these steps reflect internal risk management protocols and capital allocation requirements rather than bearish sentiment. Banks continue to monitor both paper and physical silver closely, adjusting strategies as conditions evolve. Another critical distinction is between paper silver and physical silver. Comex reflects leveraged contracts that react immediately to margin changes. Physical silver, used in industries such as electronics, solar energy, and medical devices, responds on a slower, demand-driven basis. This separation explains why futures prices may swing sharply while industrial consumption remains steady. Liquidity is another factor. As some leveraged participants step back, order books thin, amplifying price movements. These temporary fluctuations often create misleading narratives suggesting panic or abandonment. In reality, they are mechanical consequences of higher margin requirements and reduced leverage. Timing plays a significant role. Exchanges implement margin adjustments when markets are already stretched or approaching technical inflection points. These adjustments act as a reset mechanism, allowing leveraged positions to recalibrate and restoring balance to the market. Understanding this context helps frame today's volatility as procedural rather than fundamental. Silver's dual role as an industrial and monetary sensitive asset adds complexity. Monetary factors, such as currency movements and interest rate expectations, interact with industrial demand to shape price behavior. Margin-driven price swings primarily influence paper contracts and speculative trading, leaving long-term industrial demand intact. For investors, the first lesson is clarity. The initial price shock reflects leverage and structural adjustments rather than long-term bearish sentiment. Separating short-term mechanical reactions from real fundamentals is essential for making informed decisions. Today's silver market movements are a reflection of structural recalibration, temporary liquidity shifts, and institutional repositioning. The underlying demand from industrial and monetary-driven factors remains robust. By observing how these forces interact, investors can better understand why holding silver in the current environment may make sense. To understand why many investors are choosing to hold silver rather than exit, it's important to examine how large institutions view the current environment. Banks, funds, and industrial participants do not react to headlines in the same way retail traders often do. Their decisions are guided by structure, capital efficiency, and long-term positioning. When margin requirements rise, institutions do not interpret this as a signal that silver is failing. Instead, they view it as a change in operating conditions. Higher margins increase the cost of leverage, which makes short-term speculative trades less attractive. As a result, institutions either reduce position size, shift to longer-dated contracts, or temporarily step back while the market stabilizes. Risk management is central to every institutional decision. Banks operate under strict regulatory frameworks that require constant monitoring of exposure. When volatility increases, internal risk models automatically adjust limits. This often leads to reduced visible trading activity, not because confidence has disappeared, but because risk thresholds have been reached. These are defensive measures, not directional bets against silver. Another key factor is time horizon. Institutions rarely focus on daily price movements. Instead, they evaluate trends over weeks, months, and sometimes years. Short-term volatility caused by margin adjustments is seen as noise rather than a reason to abandon a position. This perspective explains why many institutional participants choose to hold through turbulence rather than react impulsively. Institutions also differentiate clearly between paper silver and physical silver. Futures markets are used primarily for hedging and liquidity management. Physical silver, however, is tied to real-world demand. Industrial users in electronics, renewable energy, medical technology, and manufacturing continue to require silver regardless of short-term price swings. This steady demand provides a foundation that institutions take seriously. Another important consideration is optionality. During periods of uncertainty, institutions value flexibility. Holding silver allows them to remain positioned for multiple outcomes without committing to a specific directional trade. If conditions stabilize, positions can be expanded. If volatility increases further, exposure can be hedged or adjusted. Selling entirely removes that optionality. It is also worth noting that reduced trading volume does not equal reduced interest. Much of the activity during transitional periods shifts away from highly visible markets. Over-the-counter transactions, option structures, and longer-term contracts become more attractive when short-term volatility rises. From the outside, this can look like disengagement, but internally, it is often strategic repositioning. Historical patterns reinforce this behavior. Previous margin-driven adjustments in silver and other commodities show a consistent sequence: initial volatility, reduced participation, consolidation, and eventual re-engagement. Institutions that understand this cycle are less likely to exit during the adjustment phase. For investors watching the market, this institutional mindset provides valuable context. The decision to hold silver is not based on optimism or fear, but on structure, demand, and strategic flexibility. Understanding how institutions think helps explain why calm positioning often replaces aggressive trading during periods like this. In essence, institutions are not asking whether silver is up or down today. They are asking whether silver still fulfills its role within a diversified, risk-managed framework. For many, the answer remains yes, which is why holding, rather than reacting, continues to be a rational approach. As the silver market moves through its current adjustment phase, the question many observers are asking is not whether prices will fluctuate, but whether the underlying reasons for holding silver have changed. To answer that, it helps to look beyond short-term price action and focus on structure, demand, and behavior across different market participants. One of the strongest arguments for holding silver lies in its dual nature. Silver is both an industrial metal and a monetary-sensitive asset. This combination gives it resilience that few other assets possess. When monetary conditions become uncertain, silver often attracts attention as a store of value. When economic activity expands, industrial demand supports consumption. These two forces do not always move in the same direction, but together they create balance. Recent volatility has been driven largely by mechanical factors such as margin hikes and leverage reduction. These forces affect how silver trades, not why silver is used. Industrial consumers do not change procurement strategies because of short-term futures volatility. Manufacturers plan months and years in advance, securing supply based on production needs rather than market headlines. This steady demand forms a base that supports long-term value. Another reason holding silver remains logical is the role of liquidity normalization. When excessive leverage is removed from the market, price discovery becomes more grounded. While this process can be uncomfortable, it often leads to healthier conditions. Markets that move too quickly in one direction tend to invite instability. Periodic resets help realign prices with structural reality. Silver also continues to function as a portfolio diversifier. During periods when equities, currencies, or bonds face uncertainty, silver offers exposure to a different set of drivers. This diversification is not about predicting dramatic gains, but about balancing risk. Many institutional frameworks include silver precisely for this reason, which supports the case for holding rather than reacting. Behavioral patterns also matter. Sharp price movements often trigger emotional responses among short-term participants. Institutions and experienced holders tend to view these moments differently. Instead of focusing on daily fluctuations, they monitor positioning, volume trends, and physical flows. When these indicators remain stable, short-term volatility loses its significance. There is also the concept of optionality. Holding silver provides flexibility. It allows participants to respond to changing conditions without being forced into rushed decisions. Exiting during volatility removes that flexibility and may limit future strategic choices. For many, maintaining exposure is less about conviction and more about preserving optionality. It is equally important to recognize what has not changed. Silver remains critical to modern technology, energy systems, and manufacturing. It continues to play a role in monetary narratives during times of economic transition. These factors evolve slowly, providing stability beneath surface-level price movement. Periods like this often test patience. Markets rarely offer clarity in real time. However, historical cycles show that holding through structural adjustments often leads to better outcomes than reacting to temporary disruptions. This does not guarantee specific results, but it reflects a disciplined approach grounded in observation rather than emotion. The rationale for holding silver is not based on optimism or fear, but on continuity. Structural demand, diversification benefits, liquidity normalization, and strategic flexibility all remain intact. While price volatility may continue in the short term, the broader reasons for maintaining exposure have not disappeared. As the silver market moves beyond its initial adjustment phase, attention naturally shifts from reaction to observation. This is often the most revealing stage in any market cycle. With leverage reduced and speculative excess trimmed, the behavior of silver begins to reflect deeper structural forces rather than short-term emotion. For those holding silver, understanding what to watch next is far more important than predicting immediate price moves. One of the first indicators to monitor is market stability. After margin hikes and institutional repositioning, markets typically move into a consolidation phase. Price may trade within a narrower range, forming a base as participants reassess risk. This does not signal weakness. In many cases, consolidation represents acceptance of new conditions and a return to balanced trading. Volume patterns offer another critical clue. During volatile phases, volume often spikes as positions are adjusted. Once those adjustments are complete, volume may decline before gradually rebuilding. A slow, steady return of volume suggests confidence is returning in a measured way. Sudden bursts of activity, by contrast, may indicate unresolved tension or renewed speculative behavior. Institutional behavior remains central. While banks and funds may have reduced visible activity in futures markets, their involvement does not disappear. Exposure often shifts into longer-dated contracts, option strategies, or over-the-counter arrangements. These channels are less transparent but provide insight through changes in open interest, positioning reports, and inventory data. Watching these indicators over time reveals whether institutions are rebuilding, hedging, or remaining cautious. Physical silver demand continues to provide an underlying anchor. Industrial consumption in electronics, renewable energy, medical applications, and advanced manufacturing does not fluctuate with daily market noise. Procurement decisions are based on production needs and long-term planning. As long as these industries maintain demand, silver retains a structural foundation that supports long-term holding strategies. Macroeconomic conditions also remain influential. Currency movements, interest rate expectations, and global liquidity conditions shape how investors perceive silver. In periods of monetary uncertainty, silver often benefits from renewed attention as a hedge or diversification tool. These dynamics evolve slowly, making them more relevant to holders than to short-term traders. Another important element is volatility behavior. Elevated volatility following structural changes is normal. What matters is the trend. Declining volatility suggests that the market has absorbed new conditions and found equilibrium. Persistent volatility may indicate ongoing uncertainty, but even then, it reflects process rather than failure. Recognizing this distinction helps holders maintain perspective. Narratives around silver will continue to shift. Early reactions to margin hikes and price swings tend to produce extreme interpretations. Over time, as data replaces speculation, narratives become more measured. Investors who focus on fundamentals, participation, and structure often gain clarity long before headlines adjust. Patience remains a defining advantage. Markets rarely reward those who react immediately to structural changes. History shows that periods of consolidation often precede clearer directional trends. For holders, this phase is about monitoring signals rather than forcing conclusions. It is also useful to remember why silver is held in the first place. For many, it is not about timing exact price movements, but about exposure to an asset with unique properties. Silver bridges the gap between industrial necessity and monetary relevance. That role has not diminished. In practical terms, holding silver through this phase means paying attention to how the market behaves rather than what commentators predict. Stability, gradual volume return, institutional re-engagement, and steady physical demand are more informative than daily price fluctuations. In conclusion, the path forward for silver holders is defined by observation, patience, and context. The market is not signaling abandonment or collapse, it is signaling adjustment. By understanding this process, holders can navigate uncertainty with confidence, recognizing that volatility often accompanies transition, and transition often precedes clarity. Silver may continue to surprise in the short term, but the reasons many choose to hold it remain grounded in structure, demand, and long-term relevance, not in the noise of any single market event.